So I was going to have this into one long lesson, but really they could be two standalone lessons. So we're going to break them down into a deeper dive into technical analysis. And then we're going to go into the second part, which is going to be risk management with your technical analysis. So let's get into chart patterns. Recognizing and trading common chart patterns such as liquidity runs, sweeps, fair value gaps, breakers, and order blocks. Now, these are the patterns I use more than those head and shoulders, the wedges, flags, certain candlesticks themselves. I use these with those type of candlesticks, and it'll make more sense when we go on the charts, but let's just go through these slides first, and then I'll show you guys some examples, and this plays into what you're going to be doing for your homework. You're going to see a lot of traders talk about price action, and price action could be a lot of different things to a lot of different people, but for me, it's the flow of price. And when it leaves and comes back to certain places that we're going to cover in the charts, that is, for me, trading price action. Now, some people trade price action and they're breakout traders. So once price breaks this box or this level, they're in. I like to get in when price is readjusting and then the continuation of that move. Liquidity runs, we've already covered these. That is the points where price has failed to go to, where people are seeing that as resistance or support on the bottom side. Price likes to go through there and then come back up and go the other way. That is a key indicator for us what we're doing in price and how to trade it. Sweeps are when they sweep below and then back up, and then a run is when it breaks through it and it just keeps going in price. Fair value gap, those are one of those big candles print. They don't have to be giant, but they're big enough where the previous candle and the next candle, they don't overlap their wicks and leaving just a solid body from that candle. And usually price likes to come back, make sure it prices that in, and then we move up forward or down, left, right, up, diagonal, whatever way the market's going to move. We'll give you examples of how to find ones and which ones we get respected. Breakers, so that we kind of already went into, that is like the mitigation block. They're very, very similar with one key difference. I'll show you guys in the examples. And then the last one is order blocks. That is area on charts where significant buyers and sellers activity occurred. So this usually leaves an area where price comes back and it bounces back up. It respects it, and then we go back up. Like I said, I'm going to show you all this in the charts right now. Reading definitions are not for many, definitely not for me. I like to see perfect examples. But if you ever need to refer this is in your slides that you have been given to download. So let's go into the charts real quick and break down these examples. I'm going to show you just on right there. I think we could get a lot of them done here. So the first one is going to be a liquidity run, and that is right here. That's our liquidity. Price ran right through it, came back up to the area. Not too important, but you'll see how that plays a part in a second. Then we have the sweep. This is the sweep up here. Liquidity, we have that double top, went up, swept, and then went the opposite way. So sweep, run. Just think of a broom. Sweep your dust. Liquidity run, you're running. You're going straight through the finish line. Then we have the fair value gaps. And something like that is this one right here. Although this one never came into play. Another example of one would be, here's a good one right here. So price went up, ran the liquidity. Usually price likes to reset. And when it reset in here, there's a fair value gap. This is a fair value gap. That is a little baby fair value gap. This middle one is very important because if it comes up here, chances of it running up here is very high. This middle one gives you that perfect risk reward. Now, it always doesn't come to this middle one. It's just a rule I like to see. If it comes up here, that's a really good play. If it's coming up here, less risk because your stop loss will be right there, but chances of it running up here and tapping your stop loss happen to me many times. Just something I try to stay away from. So this fair value gap, and then you look, well, there's that liquidity. Where else has price not gone to yet? Down here, which is a liquidity run on the higher time frames. And that would be like a little setup from the fair value gap. Then we have breakers and mitigation blocks. So let me find a clear example for you. We could use this one. So we have a high, a low, and a higher high if you look, broke above it. So we grab the liquidity here. And we broke below this low. So this lowest candle, draw that out. This is a breaker because of the second peak ran through this. So that's a breaker block. And look at how price came up. Breaker block, grab the liquidity that was built up right here, ran through. Beautiful setup, right? Now another setup for mitigation block. Yeah, we'll use this one. So high went down, created a low, and that lower high. Last candle where price ran through. Mitigation block. So it broke through, came up. Wicks are okay, poking through it, but all the bodies stayed within that block. You could either enter at the bottom or 50%. Sometimes you might not get filled in at 50%. And then you target liquidity. We got this one down here. Obviously, you don't know what's going to come down here, and we're on the daily chart, so that would be a long time you're holding your trade. But on lower time frames, I would take them around these areas, and then it protect my trade and aim for something down there. So mitigation block doesn't create a higher high on the second one. Breaker block creates that higher high on the second peak. Liquidity sweep went above, swept it, came back in. Liquidity run went through that area and kept on going. Fair value gaps, when there's a candle with wicks not overlapping. See how all these overlap and there's no gap? That's what we're looking for. And then price usually, like I said, it readjusts and then continues down lower. And you could see this over and over again. Low, low, high, broke above it. Now this one wasn't a perfect setup. Price kind of came back in. Now if you redid it, to this one right here, this mitigation block, not the perfect setup. Stop loss would have been under here. Fair value gaps. Never got an entry. Entry. Entry, but took us out. So if you look, we had the mitigation block, or the breaker block, sorry. High, low, higher high, broke through it, price came back, boom, and we went down. So spend time doing this. We're going to go over your homework later, but this is something you definitely want to pay attention to and understand. These type of support areas, these are the real support and resistance that you're going to have in the markets, and they're going to help you get entries on your trading. And you will also have different indicators to help you learn the bias for which way price is most likely to go. So we're going to add something. We're going to add a layer to what we were just doing, and that is the Fibonacci retracements and extensions. Now this is going to be pretty complex, but we're going to dive into it so you guys understand and can mess around with it. But in our advanced trader course, we will definitely fully go over this when we create our trading system and get you all set up for it. So these are the most common levels you'll see. I'm going to put my fib on there. It's going to be a little different, and you'll see 618 is the golden level, the golden area in the Fibonacci, and is used to get on entries and all that stuff. But it's easier just to show you in the chart. You'll have the slide to reference, but I'm a visual learner, and for trading, it's much easier to see it on the chart. So let me clear out. Actually, no, we're going to play with what we have here. So fair value gap, Fibonacci. You're going to take it from that high to the low because we're going downtrend. I don't have the 618 on here, but it would be, I think, somewhere in here, like literally right at the top. Let me put it on so we could see. So literally right where that wick went, we're at 106.15.7, and this one is 106.15.1. So just and I mean just under that. But playing into those fair value gaps I was telling about, how you want to find the certain one. Well, if a pullback goes past 0.75, not all the time, but let's say usually, it's a signal that we're going to break through this. But that 618 to the 0.5, that's a good pullback. That's a good adjustment on price to continue. And this fair value gap was within the 50%. So on this particular fair value gap, I would have got in at the 50% because I want to be above 50% on my entries. That's why I would not use this bottom fair value gap, because it hasn't passed 50% of that run yet to readjust price. So you're putting on a lot of risk. And then we have the extensions. So I only do halves for the extensions. So you'll see 0.5, 1, 1.5, 2, all the way out to 4. And you can see 1, we went through 0. That's the full move. 0.5, we went through. 0.1, we barely tapped, and then we ran through. And then 1.5, we ran through. Never got to 2, but we were very close. So sometimes I don't use the wicks. I'll just use the bodies of that run. And when you look now, basically 1.5, just right above it, we went through it. 2 went through, 2.5, and 3 we haven't gone through. Price went back up. So they're not It's not saying guaranteed take profit here or here. You're just seeing price is going to start reaching towards these areas most likely, and you'll wait for a sign to show that's going away. So you can see we got that engulfing here. We never made it to -3. We might be reversing, and guess what? We did reverse. So all these indicators and tools are to help you get an understanding of what price is doing, the story, and you're using them together to build your story and make sure that your story is actual truth, not fiction. And that's how you're going to start being a better trader and having high profitability trades and more wins in the market. Like I said, I know this was a little complex. If this is something that interests you, this type of level of trading, that is what our advanced trader course is for. In the next video, we're going to go into risk management with these and help you start to slowly understand and get some ideas of how you're going to build your trading strategy.